Happy to be here today. So, we're going to speak about how to save ton loads of money when you're implementing your core, choosing your core. But before that, we need to understand how do you measure it in the first place. And that's what I'm going to mostly speak about now. 11 years back, I was presenting in another seminar in Stockholm in Sweden. And of course, the topic was what are the next steps for financial services. On the top right, you can see I'm there. We were, as a speaker, I was just mentioning that, okay, it's going to be time when all your core workloads are going to move to the cloud. There's going to be a situation where you're going to start having exchangeable core bank systems where you're simply going to plug and play core bank services from the cloud as a subscription model. Now, little did I know that at that point of time, that particular event was filled with chief information security officers. And little did I know that at that point of time, if you use cloud and core bank in one single sentence, it didn't go pretty well. And I was not the most liked person at that stage on that day. But fast forward 11 years, 2022 today, cloud is the mainstay, core bank is pretty cool, and if you have cloud on, core banking on cloud, you have arrived. So that brings us today here. If you look at outside on the hall here, 10,000 square meter space, there are 8 core providers there, which I think is much more than the population density of Finland for the same area. So that means that there is something happening in this place. There is certainly something that is changing, and there is a lot of interest in this. So what is really happening to the market? There are these legacy financial institutions with the legacy, the old financial institutions with the legacy infrastructure, the technology stack that they have. Some of them are changing, some of them are yet to decide what to do. And we just heard about how iterative the decision is, or how not so easy the decision is in moving from one core to another. But I think largely, I will boil it down to the will of the management and the bank to do that more than anything else. The technology is there, everything is there. It's the amount of risk that you want to take, and what do you want to do, and how you want to manage the journey. But yes, this has started, and then today you have players moving out of the legacy technology into new platforms. There are players who still are a bit edgy and shaky. They are moving from 80s technology to 90s technology. I don't know why, but it's happening. And then you have the neobanks and the challenger banks, who in turn are still challenged. This morning we were listening to the panel. One of the panel speakers was saying that we have challenger banks who don't make money at all. So if you have an average revenue per customer of 20 euros per year, how are you going to spend money on developing anything at all? So they have their own challenges. The income streams are there. The number of customers may be there, but you need to have the ability to generate income and make sure that your costs are commensurate. But yes, they are there. The challenger banks are making a lot of waves. Then you have banks that are smart. They were taking up their businesses, breaking down into silo units, siphoning off that into new businesses, and unlocking value. And this means a lot because you obviously can change the technology. You sell off that business you spin it off into a different branding, and it gives you more flexibility and freedom to work on it. Meaning a lot of players today move off their factoring businesses separately and establish a new brand, and therefore it's much easier to get it into a new technology platform. So this happens pretty much, and this is very encouraging. You also have other fintechs that are on the cusp of growth. Usually when a fintech starts, you go to an investor and say that I have this rock star performers, I have this very cool software that does a lot of magic, and then you get money. You're not going to go the next day and say, okay, now I want a vendor to provide my core. You don't do that. But beyond a point, you do realize that you're growing, and you have to scale, and then you need to have systems that support this, and therefore you start looking at, okay, what are the vendors in the market, and how do we go about aligning something that matches my growth strategy, which is encouraging. Last of all, you have the BaaS. A lot is spoken about embedded finance. We speak about how every business becomes a business offering financial services. Yes, I'm taking this one notch higher. In my view, I think that it's going to change even further. Today, if PewDiePie wants to open a bank, two things will happen. One, he can do it. It's not so difficult. And two, within 2 years, he will have so many customers that he will put the largest Nordic banks to shame very easily. Now, you're talking about a person who has a subscriber base of 4.5 times P27. Now, what happens if he wishes to open a bank? Name a 16-year-old who does not want to have a PewDiePie signed debit card in his pocket. If today you are running a retail financial institution, and if you cannot name the top 5 social media influencers in the market that you operate, you have a problem, certainly. So it's no more, your distribution mechanics are completely different. You have to not only look at what kind of products people want, but you also want to be responsible. You want to make responsible financial solutions to the next generation. There's a lot at play here, and embedded finance is really going to change the way we're going to do it. I don't even think banks will even exist sometime later. They'll only do 3 things. They will be custodians of information, not even custodians of money, by the way, custodians of information, custodians of data. They will make sure that the regulatory aspects are taken care, and in some cases, they may lend your balance sheet. And even that is not needed by everybody. Big tech doesn't need your balance sheet. They have their own balance sheets. So a lot is going to happen on the embedded finance space, even more than what is happening today. This means your income streams are different, your cost dynamics are different. You will have to share your income with PewDiePie, for example, or you may have completely different cost dynamics in terms of how you run your business. So all of this means that players like us, it's a very nice field today, so that's why you see 8 people here outside. And all of this needs something new, and I'm not getting into the details of what kind of core bank you need. I leave that alone. I'm just going to call it a digital core, just for the sake of simplicity. Let's say that you need something new, you need something more agile, and you need something fresh and different so that it gives you the benefits so that you harness. Now, you must keep in mind that each of these players here have their own objectives. Some want to ring fence their business, some want to expand, some want to diversify, some want to unlock value. Everybody has different objectives, and therefore the cost-income dynamics can be very different from each of these players. So you have to really find out what is in it for you, what do you want to do about it, and therefore start choosing your core provider. Now, when the market is so good outside, there's a lot of things happening. Obviously, you have players like us who come back with a lot of value propositions. You have a lot of words bandied about, serverless technology, API is always there, I'm not even going to mention it, cloud is there. You talk about TCO. I don't even know why you need to talk about TCO today, but still people speak about it. You don't need to own a core bank system today anyway, in even a server. AI, well, I'm not very sure about AI in core, because double entry bookkeeping is the same for the last 150 years. I don't think you need to post a credit and a debit, you need AI, but anyway, it is there. And you have a whole lot of stuff, composing, decomposing, or whatever you call it. So how do you reconcile all of these? You have so many value propositions coming from vendors and saying that, okay, this is all that I can give. I can give you an API-first solution. I can give you something where you can quickly plug and play. All of this, but what exactly does it mean to you? I think that the one thing that you banks and financial institutions need to find out is how efficient it is for me to run it. So when I say efficient here, we're not talking about transactions per second. We're talking about what is the cost efficiency. And is it something that brings value? Because no more are you going to look at a whole big project. You're going to look at something that you're going to own for the next so many years. No. You're going to say that how is core bank as part of my value chain in providing value to my customers? And therefore, I earn X money, and what do I take to spend to get there? That's it. Its core is not going to be a great thing, that's going to, it's like, running a marathon, open heart surgery. Believe me, these equations will go out of the place very soon. It's just another service that is available for you to use, and you will be able to use going forward. So it's not something that you need to own, you need to build, you need to sweat over it with billions of euros. No. And that will happen very soon. So the one metric that you need to figure out is to understand how it is going to be efficient for me in terms of running this service and giving the value to my customers. So 2 questions you will always ask when you start off your journey on a core or even on your existing core, what does it cost for me to onboard my customers, a certain business to my customers? Now, I'm very careful in using the word onboard here because onboarding can mean different things for different people. You talk about core renewal project, you talk about core transformation, some people talk about implementation services combined with consulting, so that list can go on and on and on. But simply put, all it means is, and some projects will mean you need to migrate, some may be greenfield, you can have any which way you would think about it. But simply put, it's all this. If I have a set of customers, and if I want to introduce a new business to them, what does it take to do that? Either I bring my customer base to a new business proposition, or I include a new business proposition to my existing customer base. That's all it takes. So you look at it from a very simplified point of view to say that, okay, I may have 100,000 customers, 150,000 customers, and if I'm going to have them on a new platform, what does it take to ensure that these 150,000 customers get these business services? Now, but this is important to do the math here. Let's assume that you spend 60 million euros and you have 150,000 customers. To onboard them on a new platform, you're talking about 400, do the math, is 400 euros per customer. And even if you're going to amortize this over, say, 4 euros a month, it's going to take you 10 years. You'll practically never get your money back. And by the time you finish amortization, you need to perhaps change another system. So we need to be very careful in understanding what does it cost to roll out a business service. Whichever way you put it, you're making a drastic transformation, or you're going to make it, on a coexistence basis. However you do it, you just make sure that you have the goal of providing the business service, and what does it take to roll out that business service. The second question, of course, is what does it cost to run the business service on a monthly, yearly basis? Because if you look at the core only as one piece of the whole value chain that you want to provide end value to the customer, then you just want to calculate your unit cost of each of these pieces and see what does it take for me to run this service so that I give this benefit to the customer. It's pretty simple. Now, when you're going to do that, you obviously have to understand what function does this deliver. And that is important because, again, a lot of us come from different backgrounds. There are players who started off with the customer experience layer and then started building the core. There are players who say the core is pure and everything else is outside. And then you have to look at what, suppose if you say that I'm going to send out notifications to my customer outputs, dunning process, is that core? Different views. But it's good for you to understand what do you mean by a business service. Is it only the core, which means just the product packaging where you have the lifetime contract management? Or are you looking at the customer experience, you're looking at the onboarding into it? If as much as possible, try to silo these out so that you have clear, differentiated services and you can calculate the cost of it. So if you're going to say that what does it cost for me to onboard a service, then you need to define that service, because you may have multiple players in the process. Like one of the speakers was saying that we will all move into a very federated ecosystem where you'll be buying services from different players, and it's of course the ability to integrate this in a very good way, of course API driven, which is the word being used. So when you do that, you need to understand all of these costs and make sure that each of these services are costed separately. And therefore, it's very important for you to define this service. The one key metric that we found pretty good for us when we spoke to our customers, when we started calculating what does it take for our customers to be on our core, is the cost-to-income ratio. So we don't talk about, okay, I may have thousands of APIs, I may use server workload of X, Y, Z, it's on the cloud, doesn't matter. So all that we speak to our customers is just two things, what's your cost-to-income ratio? So what is the cost for you to have our services, and what's the money that you make on our services? It's simple as that. So very clearly put, is just that for every 100 euros you spend on the platform, how much do you make? So we're talking about, this morning, if one of the challenger banks, we're saying that they make 20 euros per customer per year. So obviously, where is the money to go and invest into something else? So clearly, we have to understand how much money you make from the platform and what is that you're going to spend on the platform. Now, this is not so clear as it is, meaning this is not so easy as it is, because the definition of cost, the definition of income, and the definition of service, all these have to be pretty clear. Cost can be different. It can be cost of subscription cost. That's the easier thing to calculate. It can also be the total cost. Now, what the difference between the two? Subscription cost is the cost for running the platform on a monthly basis. Could be, that's easy to calculate. But you also have total cost, which will include what about customizations, what about change requests coming in, what about support services that you want to ask. So again, look at it in terms of what is the cost you're going to take. Are you going to take only subscription, or are you going to take the total cost that you want to have? Income also can be different. Again, are you going to take gross income, or are you going to take the net income? That's also very important for you to consider, in terms of what is the income that you take. And lastly, what is the business benefit? Are you only looking at one type of the business, or are you looking at the whole business end-to-end, assets, liabilities, payments, cards, whatever what you have? So we need to make sure that you define the cost, you define your income parameters, and then you define for what business service that you're using it for. Then you put this ratio, and it's pretty much clear. In fact, we are so convinced about this that we kind of adopted the same cost-to-income ratio back into our metrics, and we have the same for every project that we have. So when our customers are having a good cost-to-income, we also try to find out whether we have a good cost-to-income ratio back in our projects. A few use cases that we have. This is a customer based out of Sweden. So again, let's put the same metrics here. We covered the asset side of the business for this customer. And so that's very important to note, that we cover the asset side. So that means somebody else covers the liability side, and there is a different cost to that. So we cover the asset side of the business, and you can see the asset growth for the customer that when we onboarded the customer on our platform in 2020 October. And the cost to income ratio for this customer, when we onboarded, they were spending 7 SEK per 100 SEK, and that has come down today to less than a SEK. Now, again, few caveats here. The business is only on the asset side, which means it is gross income. The net income is something else, so obviously the ratios will differ. And in this graph, we have taken the subscription fee, not the total fee, which is not very different anyway. But the net outcome is that for every 100 SEK the customer earns on the platform, the customer spends less than 1 SEK, so which means that you have 99.5 SEK available for you to do something else, and that's important. So this is one customer case that we have. Another one closer here in Helsinki. This is a customer where we have, it's a institution based in Finland. We cover both the asset and the liability side for this customer. That's the scope. In terms of the cost to income, you're looking at the subscription cost. So here I have two data points. The blue line shows the subscription income, cost to income, and the red line shows the total cost to income. So you can see the peaks over there. The peaks are nothing but those months when the customer has ordered for new customizations and paid for something more. So you can see the difference there. So obviously that has to go into your cost to income ratio. So when you're looking at the subscription fee, you can see that the customer pays around 2.8 euros on an average for every 100 euros they make. But if you look at the total income, it's around 5.24 euros. So even if you take the total cost for the customer, it comes to 5 euros plus, and that means that you have 94.5 euros for yourselves. So again, it's important to understand what is the cost, what is the definition of the cost you're using, what is the definition of the income that you're using, and what kind of services that is being rendered. So with these factors put together, it's pretty clear for us to understand whether this is profitable, is it not profitable, and then of course you have your other sliders to have, how much you spend on marketing, what is your cost of acquisition of your customers, all that will come into play. But this is a very clear indication. Now, in terms of scope for this customer, again, we manage not only the core, this cost is also including the customer experience channel. And for the previous customer also, we offer the customer experience channel as well as the core for the asset side of the business. Includes SME onboarding, it includes consumer loan onboarding, it includes running the whole platform for consumer as well as SME loans. So if you have these metrics pretty clear, it clearly says what is the kind of money that that you're spending. Now, how to go about choosing this and making sure that you make the right decision? Well, there are so many factors that you have to take into consideration when you want to choose a co-bank, and therefore make sure that you are very successful in having a very low cost-to-income ratio. It all starts off with the choice of the core bank, of course. In some cases, you will not, the solution may not be congruent to your business model. And this happens many times. You have a consumer loan system being positioned for an SME loan. And 100% it won't work. Meaning it will start working pretty well. You will give up the loan. You will make sure the accrual happens. But an SME loan is, especially a very high-defined SME loan, is far different from a consumer loan. And then you will have a problem later on when the loan gets into restructuring modes and stuff like that. There will be a mismatch. So you need to understand whether there is a clear match between your business model, what you want to do, and what is the capabilities of the solution. You move further, there will be a lot of cost that gets added, and a platform may be too complex. You may need an army of consultants to implement it. That naturally brings up the cost. And you have quite a lot of things that stack around. So if you take each one of these points and understand very clearly what goes into the choice of your core bank, and these are all cost factors, meaning I'm not saying it is core bank X or core banks Y, but whichever way you look at it, you have to take all these factors into consideration. Implementation projects may run into years and years because you don't have the ability and the vision for coexisting. A rip and replace is going to be very risky. So you need to understand what all goes into your vision of what you want to achieve, and therefore do it. Cost drivers to maintain success. Again, it is similarly on the same lines. You need to think about all these points and understand where the cost really comes up, and therefore make sure you make the right choices. Now, I'm going to leave you with one thought. This was a LinkedIn post that I put up in a few months back. Imagine if you have 100,000 customers, and all it takes for you to service these customers on a digital core is just buying these customers a cup of coffee every other day, every other month. You have made it. So look at what is a unit cost that you're going to spend for every customer, be it a customer unit cost, be it a unit cost per assets under management in billions. However way you look at it, if you have your cost-to-income ratio very clearly defined, then you're going to make it. Yep. Thank you.
Thank you, Premkumar.
Thank you.
Thank you.